the folks that I know that are building a business, they're entrepreneurs. They built a business that lasts, that's dominant and has scale. They don't go outside of their credit box, and they don't go into new markets on a whim.
Welcome to Multifamily Insights. I'm your host, John Kasman, and I want to thank you for joining us for another great episode. If you're getting good value out of the show, please leave us a rating and review. We want to get your honest feedback and learn anything we can do to work harder for your investing goals. If you haven't done so already, make sure you hit that subscribe button so you don't miss an episode. Now, we've got a great show today. We're going to be talking to Kevin Kim. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to KasmanCapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to KasmanCapital.com and click on the Mastermind button today. Kevin Kim leads Usury LLP's corporate and securities practice. His expertise lies in fund formation, private placements, and other securities offerings for private lenders, real estate developers, and investors of all sizes. Now, he's a nationally recognized expert in mortgage fund information, and he's the lead instructor for the American Association of Private Lenders Certified Fund Manager courses. On top of that, he's the host of the podcast, The Lender Lounge with Kevin Kim. Let's welcome to the show, Kevin Kim.
Thanks for having me, John.
Absolutely. Hey, Kevin, it's great to have you on the show today. I went over your bio at a very high level. Why don't you take 2 minutes and fill in some of those gaps?
Yeah, so I'm a partner here at Usury LLP. We're an interesting law firm. We're the nation's largest private lending law firm. We're hyper focused in all things private lending. So for the uninitiated, that revolves around business purpose, residential mortgages, and commercial real estate loans, mostly in the transitionary sector. So bridge loans, construction loans, and then also term rental loans. Most of our clients are non-bank, either mom and pop operation all the way to the institutional types. And my practice revolves around helping them structure their capital formation needs, whether it be a fund, whether it be a crowdfunding offering, whether it be a little more advanced. And so the firm is designed around serving that industry's needs. Now, granted, I also do real estate syndications and real estate funds and stuff like that. But, the major area of my focus is definitely in the securities and fund formation for private lenders of all shapes and sizes, right? We've got clients all over the country, from your startup to your one-man band to, multinational businesses that are financially institutional investor backed, those type of organizations. So, we run the gamut in the space, and I thought we'd have a good time talking about it.
Absolutely. Hey, listen, appreciate you giving us that context, because I think it's helpful just to understand and wrap our heads around it. So you mentioned that, you're at you're at the firm. It's the nation's largest private lending law firm. You do touch on real estate syndications and real estate funds, which our listeners should be somewhat familiar with based on the episodes we've done. So we're not going to go deep into that today, but I do want to talk a little bit about kind of, what it means to be a private lender. So for our investors who maybe have capital, they are familiar with investing in syndication deals.
Sure.
Maybe they've considered being a private lender to one investor. Talk to us about what that looks like, and how does that differ from maybe creating a fund that is specifically designed for private lending?
Yeah, so most people start out lending their own capital, right? And most people who are household names in the private lending sector, aka the hard money sector, private money, it's all the same industry, right? The idea here is these are non-bank lenders who are making loans for investment properties. So a lot of lenders start out with their own capital, right? They lend their own money. They do a few deals on their own, and they realize, hey, it's a pretty good investment, right? Whether it's active or passive, it's a great investment because you're hedging your growth investments with a more income-based investment. And it's short-term in nature. Most of these loans are 1 year, 2 years, and sometimes 3 years. And so you're dealing with a short-term loan, higher rate, asset-based transaction. Usually the lender knows real estate, and so they can easily value the property. They have no problem buying the property if the loan goes to foreclosure. And so there's the business reasons are all there. What complicates things are the various weird regulations or lack thereof in becoming a private lender, right? And so one of the myths in the space is that, oh, it's commercial, I don't need a license. Or it's commercial, there's no cap on usury. Or it's unregulated. Absolutely not, right? After 2008, the rules of the road are pretty strict and they're very local. So if you're a lender in California versus somebody being a lender in Texas, the rules are different, and this is where the loans are, right? And then you have to think about, okay, well, I've hired Jurasi and we've gotten all the compliance and licenses that we need. They're doing our loan documents. Now we got to fund more loans, and that's when the conversation of capital comes up, right? So that's when the lender realizes, okay, well, I'm capital constrained. I've got a few $1,000,000 lying around. I can start doing my own deals. I'm running out of money. So that's when they start thinking about, okay, well, I need to find other sources of capital, much like real estate syndicators, much like real estate fund sponsors. They're going to either raise money from one of two primary sources, right? Passive investors or the institutional investor. And both are on the table in our sector, right? They're both there, and they're both viable solutions. And in fact, I encourage clients to use both. And effectively, you're going down the path of, well, I need to start thinking about creating some type of funding vehicle, right? Entity. And oftentimes the solution for that is a fund, much like in real estate, right? We need to raise money to be able to acquire more assets in real estate to make more loans in private lending. And from there, you start working with some of the institutional guys to maybe sell the loans to for liquidity, maybe broker off the loans that you don't want to do or don't want to keep, so on and so forth. And that's kind of the evolution of a private lender, right? So most people start small and they realize, well, hey, we're starting to pick up a lot of traction because we know a lot of borrowers, we know a lot of developers, and we're pretty good at this. And it's a lot easier to pick up if you come from real estate, right? Because one of the hardest things is like valuation and basic accounting and stuff like that. And so, they start getting a taste for it, and it really is a very attractive business model because it's much more lucrative in the long term because, in real estate, deal flow fluctuates a lot more when it comes to opportunities, right? And in this sector, you can find more opportunity because there's just a lot of real estate investors in the larger community. So we find that, like, I would say about 50% of our new lenders being formed, and I've been doing this now for 11 years, come from either their former flippers, their former multifamily investors. They've had previous experience with the syndications or real estate funds, and they want to try their hand at private lending, right? And on my show, like, we've interviewed tons of folks who come from that world. So it's a very logical transition for someone in real estate. And also it kind of works well even if you want to stay passive, because this is basically a fixed income strategy, right? So almost like with multifamily, like you found the perfect property, it's stabilized, and now it's producing a nice monthly, return. It's like that, but you're just not, you're not directly owning the real estate. So you don't have to deal with tenants and and the headaches that come with all that, right? So granted, not as many tax benefits, but still, the headaches of no tenancy and headaches of no, zoning issues or, HOA issues or whatever that is, though that gets remediated through the idea of a higher rate of return generally, right? So that makes it very attractive for your passive investor who's saying, well, it's hard to find good deals as an LP in multifamily right now, but I still want a nice fixed return. Plenty of opportunity in private lending. So
yeah, I think when you think of private lending, you talked about just kind of why so many people with a real estate background are interested in becoming private lenders, right? Because you already understand the business, you understand what a good deal looks like,
and they probably also borrow too. They probably also borrow money from a private lender too. So
absolutely, and being on the other side of that table probably allows you to recognize that, hey, there's some opportunities here. Let me find good people, and you probably built up a good network. So there's ways to make money in that field. You mentioned the term hard money, and I just want to start at a high level, right? So like private money, hard money, some of these feel interchangeable for some people, but I assume
Yeah.
there are some real definitions. So can you explain if there is a
So,
difference, and if
this
so,
is
what
more
is
of an
it?
industry term issue, right? So the industry's grown up. So when I first joined this firm back in 2014, it it was back then everything was just hard money, very local, right? And very kind of privately run, no institutional access, right? Very little institutional access. And pretty much was an entrepreneur who either had his own capital or raised a fund and was making asset-based loans, right, for these types of investment properties, whether it be residential, multifamily, commercial. It was the same type of loan. But starting in 14, 15, 16, we started to see some institutionalization to the space, and the term private lending got coined. And the funny part was actually Anthony Gerasi, the founder of Gerasi LLP, he founded an association back in 2008, I believe, called the National Hard Money Lending Association. And there started to become a stigma with the word hard money. I don't really understand it personally, because when I talk to my real estate clients, right, they think, oh, I heard about you guys are a hard money law firm. Like they don't have a negative connotation to it, but for some strange reason, it had a negative connotation. Hence the phrase private lending came out. He changed the name of the association to the American Association of Private Lenders. And so, that's really the difference. Other people will say there's differences. I personally think there really isn't. It's still asset-based lending. Yeah, there might be different underwriting criteria, but there is with any kind of lending, right? It's still asset-based lending. It's still focusing on the whole non-owner occupied business purpose residential sector and the small balance multifamily sector, and some mixed use, ground up construction as well. And it's really meant for that type of borrower. Ultimately, it's still, somewhat asset based. Now, the institutional guys will do a lot more underwriting because they have to fit the institutional boxes. So they run credit, they run appraisal. And so right now, if you look at the market, the traditional hard money market versus the private lending market, there's a little bit of tension there, but ultimately the same property or loan type is being done. The underwriting parameters are a little bit different, right? So the institutional types who are really focusing on private lending are doing more institutional underwriting. They're doing the appraisals, they're doing the credit, they're running they're doing a lot more, deep dive on the borrower. Whereas a true hard money lender is doing, some type of valuation, whether it be appraisal, BPO. They typically don't run credit, and they're oftentimes focusing on the value of the real estate, almost exclusively, which to me is still the driving factor for everybody. But there's a little bit of sensitivity on the institutional side. They need to make sure that these are bankable loans. So they add all these underwriting components. Not a bad thing, actually, right? It's taken the industry from, projected 5 billion to close to $2 trillion in volume. So, I think it's a good thing for the market, and there's a lot of drama around it within these circles. But for me, I always say, hey, what does your borrower call it, right? What does the actual real estate investor think of you, the lender, as? And if in his brain, he refers to you as a hard money lender, even though you don't think you are,
Right.
well, I'm sorry, you are, because the customer is
Yeah.
right. You know what I'm saying? So
Well, there you go. And I appreciate you giving that context, right? So little nuances of the terminology there, but either way, it's private money, hard money, whatever you want to call it. It's
sure.
non-traditional financing. I think the
Exactly.
reason it's becoming even more important to understand is, when we think back to 2008, 2009, a lot of those traditional banks and traditional lenders really got tight, and it was really hard
Yeah.
to get capital to find deals, even if you found a good deal. And that's when people looked at more creative financing, seller financing, or hard money loans.
Hmm.
And, there's an anticipation that the market is going to go in a similar direction now. So for those folks who want to open up their options and explore, creative financing structures or go with private money, what are some tips or strategies to either A, identify good resources, or B, just position themselves to be attractive for those private lending opportunities?
I would probably, first things first, is kind of figure out what markets you're going to be lending in, because every state's different, right? So the general consensus is like, he kind of split the country in the middle, right around Texas, right? So Texas is that line, draw a line from Texas all the way up to Minnesota, right? So, and that's the reason why it's kind of west of that, there's a lot more regulations and licensing rules. East of that, generally a lot less. I don't want to go into all the details, but you got to think about licensing, because every state's different, right? So do I need to be licensed to lend in that state? And frankly, it's just web of confusing navigation issues. Because if you're doing your average consumer mortgage where it's owner occupied and primary residence, the answer is licensed in every state, right? But in this space, it's not. So first things first is figure out, okay, well, I want to lend here, and do I need a license? The next thing is, well, how do I go about doing these deals? Like actually like papering these deals. So a law firm like us can also help you paper the deals. We close loans for lenders across the country.
What
And
do
we
you mean when
pride
you say
ourselves
paper
on
deals?
so you need loan documents, right? So you need
So actual
actual loan
loan
documents.
docs.
You need to know what the checklist is. You need to know what, how do I get, and we pride ourselves on representing new lenders all the time. So definitely, it's important to contact a law firm like us, and shameless plug, right? But we've taken a lot of small lenders to national scale. So there's that. And then the other tips and tricks would be figuring out kind of what you're comfortable with, because a lot of times, someone who comes to this space, they see a lot of random opportunities come their way, and they're not even sure how to gauge the risk. And I would tell folks, when in doubt, go conservative. And in this sector, you may get an ask for all types of transactions. First lien is not the same in every single market, right? So you have to understand the market. You have to understand the values, right? If for example, I'm in California, a loan in Irvine is going to be valued differently than a loan in San Bernardino. Even if the LTVs are the same, the real estate's different, right? So understanding the real estate, the valuation issues, right? What you're comfortable with, what's your leverage, how far are you willing to go, right? Some lenders that I know who are starting out, they won't go past 65% LTV as is value. They're very conservative on markets that they only know. Other lenders who are more, I guess, understanding real estate, understanding what's considered market, and really knows the borrower and they're comfortable with it, going a little more heavy on the risk, 75, 85. How far are you willing to go on that risk, right? And that basically means you're lending that much against the real estate. Granted, you got a first position lien, right? Other things like, figuring out what that's going to be. And I would say when we're starting out, keep it simple, keep it conservative. And the deals, there are deals out there. And then that's the next question, right? How do I find these deals? Immediate network is the obvious answer, right? Your RIAs, your masterminds, your immediate network of colleagues and friends, they probably have a need. Then you expand into industry events, right? So start going out to different industry events, because there are brokers out there that will love the broker to a much more flexible lender who's usually going to be smaller and more nimble, right? That's going to be the next thing to think about, right? Getting more opportunity. And then after that, it's a matter of building the business, right? So you've got a few deals under your belt. You've got a feel for this. You got to start thinking about expansion. If you want to expand, what's your vision? If you want to really build this business out, then, usually a lot of clients will give me a call and we'll talk through the strategy, because we'll have to talk about, what's your org chart going to look like? What's your licensing situation going to look like? What's your capital situation going to look like? What's your leverage situation going to look like? And do you have liquidity solutions to sell the loans? All of this stuff is going to be on the table, and it's all part of the conversation to scale. But those are like, for a brand new lender, I would say that's kind of step 3. Step 1 is to get some deals under your belt. So making sure you're doing them compliantly, because the last thing you want is the California Department of Financial Protection and Innovation knocking on your door and say, hey, not only did you do a loan without a license, but you violated our usury laws, which is surprisingly very low, right? California is 10%. So, those things are things you want to watch out for. And oftentimes there's a lot of myths. And so what I get really nervous about is a lot of bad information about private lending and commercial bridge lending. Unless you talk to someone like myself and who really lives and breathes this stuff, I wouldn't rely on it, because it's really tricky. You'll hear, oh yeah, we do loans in that state without. I've heard this a million times. I can lend in California without a license, right? Like, absolutely not. So things like that, right? Or I can make a loan in Arizona without a license, right? Absolutely not. There's a lot of states like that. So things like that are important to think about as part of the first stage. And frankly, like I do these calls all the time, and I don't even charge for the first consult. So like, why wouldn't you take advantage of that?
Absolutely. Kevin, let me play back a couple things, right? You talked about, first and foremost, you need to understand whether or not you need to be licensed in the state you're looking to operate in, right? So understanding the license, recognizing that from a general high level standpoint, states on the West Coast are going to have more legislation around needing a license than maybe on the East Coast. But then you want to make sure you're picking your market, understanding what markets you're going to be in. And then you talked about understanding the LTV or whatever your lending strategy is, right? What LTV are you willing to do? How conservative, how aggressive? And then networking. As you're looking to grow and to expand, you may start with friends and family, but then you may want to go out to other folks who are, maybe at meetups or conferences, other folks in the industry,
Sure.
but then having a plan to actually scale and grow. Compliance seems to be the real big thing here. And I've got one question that I want to get to another question here, but the first one is, just I think there are a lot of assumptions that, hey, if it's a private loan, let's say if you and I were talking,
Yep.
that I could do a loan for you. Is that accurate, or would you need a license at a certain threshold, or is it if you and
So,
I had a
so that's
deal?
the fascinating issue, right? So, for example, in the state of California, the threshold is you can do one loan every 12 months without a license. What
Mhm.
they don't tell you is that implicitly in that exception is that loan must comply with California's usury limitations, because the only people that are exempt from usury are those that are licensed as either a real estate broker or a California finance lender. So that's the implicit kind of weird logic, right? So
Mhm.
how do I solve that? Well, you get licensed, right? Because the usury cap is so low in California, it's 10%. So a private loan is typically nowadays, especially with, prime being now in almost 9%, we're talking
Right.
about a loan that's going to have to be above that, right? And that interest rate is not just 10%, it's 10% plus fees annualized in. So you're unlikely going to be able to
So that
fall
includes
under.
origination fees and anything like that too.
Exactly.
Yeah.
So I always talk to the client. I always hear this stuff from clients all the time, and they go, "Oh, you know, it's privately negotiated." Well, granted, it is private, but the state has an interest in regulating this, especially
Mhm.
if it's tied to residential real estate. Commercial real estate, there's a lot less regulation in general. So 5+ unit multifamily counts as commercial. You're not going to see as much licensing regulation, but the usury caps still apply. So it's a very nuanced topic. The nice part is, though, is that our firms put out so much information on licensing. You go on our website, there's so many videos and articles about licensing that, like, it's not hard to just check that off and, or just give us a call and we can talk about it. Because it's it's one of those things you don't want to mess with, because it's not just because the states aren't going to hit you for licensing. They may hit you, but they're not going to say, "Oh, we're going to invalidate the loan for that reason." That's not the concern. The concern in California and a lot of other states is usury, because their usury is tied to their licensing, and so then you got a problem. Some states are also kind of aggressive, like some states like in the Midwest, like Minnesota, they're very aggressive. Oregon, they're pretty aggressive. They're gonna really make make your life difficult. And the process when dealing with a government agency is always subpoena or examination, where they want you to open kimono and give them
And no
everything under the
investor likes
sun.
that, right?
No one likes it, and you have to pay an attorney to
Yeah.
defend, and not worth it. Especially considering, like, there's so many states where you don't need a license to do this. For example, like Texas, one of the biggest markets. Texas doesn't require a license to make these kinds of loans. Illinois, no license needed. Colorado, no license needed. Washington, no license needed. So even on the Western markets, you can still do loans in good markets. Frankly, yeah, the Western market, the California, Arizona, Nevada, the big markets are going to be tough. But then again, there are also workarounds. So, like, it's important to call someone like us to walk through this.
Yeah.
Don't want someone to just kind of like, "Oh yeah, it's privately negotiated. What can go wrong?" Yeah, well,
A lot.
let's just say, even in your example, right? Let's say no one finds out. The government doesn't find out. Well, let's say the borrower relationship goes sideways. Now the borrower has a claim against you for violating usury, and can call a prosecutor if they want to, which is very
Yeah.
rare, but technically speaking, they could. So, not worth the headache.
Yeah.
Especially
Can
after
you
do a 30-minute phone call with our
yeah.
office. You won't be charged a dime for it.
Can you explain usury? You said it a couple times, but that may be a term many listeners are not
Yeah, yeah,
familiar
yeah, yeah,
with.
yeah, yeah. Usury is the legal limit, the legal maximum that you can charge interest, right, on a loan. Every state is different, right? So, for example, California's maximum usury cap is 10%, but you're exempt if you're licensed. Texas's usury cap is 18 or 28, depending on the transaction. So every state's got different usury caps, right? And so, even if you don't need a license in a given state, you still got to think about their local usury laws. So Texas is a good example, right? Private lenders in Texas, they don't need a license to do multifamily or investment residential, but they have to think about the 18% cap, which is a very high cap. So you're in good shape, right? So and some states say if it's a commercial transaction, there is no cap. And this is also very important because every state is different, right? And so and that's also why it's important to think about, talking to a private lender specialist, because there's not a lot of law firms that have that information as it pertains to this particular lending, right?
Yeah.
A good example, it's really confusing, is Tennessee. Tennessee's maximum usury cap is prime plus 2. But what's funny about that is that you can actually borrow out of state law if you don't have a connection with Tennessee, right? So I can use California law and lend in Tennessee at a higher rate than their usury cap, right? So there's all these weird nuances, and that's why it's so important to think about just a brief conversation about compliance. And when you're starting out using a law firm like ours, if you use our law firm to draw docs, our attorneys will also guide you through that kind of stuff, right? They're gonna hold your hand a bit, and that's very, very valuable.
Yeah, I think that's so important. If you're going to go down this pathway, if you're serious or interested, even if you've done private loans up to this point, with just one investor, and a lot of times that happens with flippers, right? They may go and find an investor, and hey, okay, I need 50,000, whatever it is, 20,000. Okay, great. You do a deal, and now that's a way to have the money they need. But on the same note, if you're going to do that, you want to be aware of, any potential legalities or concerns that may be coming in unintentionally. So
Right.
it's definitely worth, reaching out to someone like yourself and your team to learn a little bit more. I know when it comes to market selection, we've talked to other folks who focus on note investing. And I
Yeah.
know that from a note standpoint, there are certain markets they avoid. I'm trying to remember the terminology that they use, but I think it has something
Trustee
to do
versus
with like
mortgage, non-judicial versus judicial.
non-judicial. Yes, that's it
Yeah, that's
exactly.
a
Can you explain a
foreclosure
little bit
issue.
about
Yeah,
that?
yeah, yeah,
Yep.
yeah, yeah. So the country has two different types of foreclosure processes depending on the state. Some states have said we're going to let you foreclose via what's called a non-judicial foreclosure process, meaning that you don't have to file a lawsuit, right? You don't have to file and serve to foreclose. You process the foreclosure outside of the judicial process. It doesn't mean you don't have the option to sue your way through foreclosure. It's just another option to process foreclosures more expeditiously. California is a non-judicial state. Texas is a non-judicial state, right? So you can process foreclosure more efficiently. Other states, and tend to be more East Coast, are judicial states where you have to file a lawsuit in the courts to process a foreclosure. Now, this doesn't necessarily mean it's the end of the world, right? So, a lot of states have unique programs that are designed to expedite commercial purpose foreclosure, right? So, for example, a lot of lenders think that Massachusetts is very onerous to foreclose, when in reality, it's almost as efficient, if not more efficient, than California. They're right around the 90-day window. So this is about how you can foreclose on your borrower and how fast you can. And logically, if you've got a court involved, it drags it out, right? So New York's the most famous judicial foreclosure state. Foreclosures can take upwards of a year in New York, right? So lenders think about, well, what are my solutions? I want to lend in these states. What are my solutions to mitigate my risk when it comes to foreclosure? And so whether you're a note investor or not. And so it's not the end of the world to invest in loans in judicial states. It's a question of how are you planning through mitigating your foreclosure delay risk, right? And so some folks will have a negotiated deed in lieu. Some guys will do, they'll do an equity pledge of the borrower company, the borrower LLC. Do a lot of different strategies, personal guarantees, a lot of different strategies to mitigate that risk, and ultimately negotiate take back of the property without having to go through the actual foreclosure process. So
If I were interested, or if an investor or listener were interested in launching their own fund, right? Their own fund here, private lending fund, what are some questions you would want to get confirmed? We've talked about kind of the
yeah.
strategy and the business plan, those kind of
Well, it's
things,
kind of
but
two big buckets,
what's your
right? So there's
process?
the
Yeah.
business side and there's the legal side, right? So on the business
Hmm.
side, I'm going to ask them kind of what are their lending parameters? What are their markets? What type of loan, what type of risk are they going to be putting in the portfolio? Is it going to be all short term? Is it going to be some long term? Is there construction risk? And then also kind of track record, because the concern is always when you launch a fund, raising the capital is a very important issue and the biggest challenge for most new fund managers. But at the same time, you also have to be able to fill the bucket with loans, right? So that's going to be important. So track record is going to be important. I don't always say that a fund's for everybody, right? I have an article on this recently. I wrote the fund is not for everyone. If you're a hobbyist, if you're a passive note buyer, I wouldn't, right? I would actually start thinking about investing in these things first, and then thinking about scaling up that way. The next question is legal, right? It's always about, we got to figure out the path forward because we're selling securities now, right? So much like your real estate syndicators, we got to think through Reg D, Reg A. What are we doing, right? We doing Reg D, 506B as in Bravo. We're doing 506C as in Charlie. What are we doing, right? And then we also got to think through, and if you want to do crowdfunding, are we doing Reg A? And all the things that come, all the onuses that come with that, right? And then some clients want to be able to go beyond that and think about future strategies and at the register level, right? 40 Act fund. But not for your first fund. Your first fund, I always recommend a D, much like its syndication, right? Concentrate on accredited investors, but some clients don't want to do that. And I'm going to advise them on the risk of not doing that, but ultimately it's their call to make, it's their business. So A is on the table for that. But yeah, that's kind of the next step, right? And we're going to look at, first question is going to be, what's your investor profile target, right? Are they going to be accredited, not accredited? Are they going to be high net worth investors? Going to be family offices? Are they going to be endowments? Are they going to be, what do you want to attract, right? And what do you have access to as well? I always ask them, I always tell people, if you think you're going to be able to launch and go raise $100 million from a large family office when you have no experience, it's a pipe dream. You're going to start with your immediate network first. Yeah. Then the next thing is going to be about advertising and marketing. Do you want to advertise the fund? Do you want to solicit investors generally? Talk to people that you don't know about the fund. If you want to do that, then 506C as in Charlie is your only option, right? If you want to stay within Reg D. So we go through that conversation, and then we talk about economics and strategy and structure and tax, and that's kind of the second level topics. But the first two big areas are, which exemption are we using, and what's business wise, what's your track record, what's your history, what's your vision, and see if they line up. Because it'll be one every kind of 5 or 6 calls. I'll meet someone who wants to do a fund. They learn about funds, and I learn more about their business. And I tell them, let's put a pause, go get some more deals done, right? Go get some more interest from investors, and then let's talk. Because I don't want the client to spend that kind of money and not be able to launch it, right?
Yeah.
Because you got to be able to sell it. So
absolutely. Yeah. Kevin, is there a minimum fund amount you would say, hey, if you're looking to do less than this, don't really go the fund route?
So the threshold tends to be monthly volume, right? So where we see clients really start to think about fund is, they're climbing up to the multi-millions a month. They're doing about, they're probably doing about 1 million a month, maybe a little bit 2 million a month on their own, maybe with some, note investors here or there, brokerage or table funding or whatever. And they're getting up there, and they're right about, maybe 3 to 5 million a month, and they're really running into kind of brick walls, right? And the brick walls are capital constraints. They're getting tired of doing the co-lender model with note buyers, note investors. The institutional table funding solutions don't really fit everything they're doing. They're scaling on the origination front, but they just don't have the capital arrangements correct. We usually have a conversation then. It's okay. It's kind of small, but it's enough to get the ball rolling. I've had clients who do less than that, but they've really decided that they want to do a fund because they don't want to work with institutional types. They want to do everything themselves. The mistrust, and I can appreciate that, right? There's been a lot of ups and downs with Wall Street, so they want to do everything themselves. And so clients will start out, and they don't want to deal with co-lenders, so they'll start out right away doing it. I'm okay with that, but I always want to make sure that they have, what's your how fast can we raise this capital? Because I don't want you to start this thing and not be able to raise it, right? So I always ask the questions immediately, what's your network look like on the investor side? Have you raised money before? That kind of stuff. So.
Makes a lot of sense. Well, listen, you've got a lot of information, not just here, available on the website and also through your podcast as well. So what we're going to say is if anybody wants to learn more, check out the website, GeraciLLP.com. That's GERACILLP.com. Plenty of more information there. Right now, we're going to go to our round of insights. Kevin, give me a failure or an apparent failure that set you up for later success.
Well, one of the failures that really taught me a lot was earlier in my career. It was here at Jurassic, actually. I made a pretty bad mistake on a client file, and a lot of attorneys freak out, right? And they don't know what to do. And sometimes they put their head in the sand. Like, it was just, and Anthony really coached me through it. And one of the things and it's kind of counterintuitive for a lot of lawyers, is sometimes you just need to own up to it and tell the client how you're going to fix the problem, right? And I did. And it was interesting, kind of a human psychology lesson that, it's not necessarily about the mistake. It's about accountability for the mistake and remedies for that mistake that people want that the clients, anyone wants to learn, right? And wants to know about, and make sure that, yeah, mistakes happen, as long as you're accountable for it and you're not trying to, point fingers, lay blame somewhere else, or not provide a solution to the problem. So that was one of the biggest lessons that I learned early in my career. And I think I teach my team members, and I still live by it. Like, I don't necessarily freak out. I talk to the client, here, we've had this snafu, here's the issue, we're going to solve it for you. And typically we find ourselves that our clients really appreciate the honesty, because lawyers don't have the best reputation when it comes to this kind of stuff, right? So
That's right. So hey, give me a digital or mobile resource you recommend for your business.
Digital or mobile resource. So for me, I guess the biggest thing that I use a lot these days is it's not necessarily an app. It's a networking tool, right? So it's kind of two pieces, right? So we throw our own conferences, right? And so we have our upcoming summer conference in August in Las Vegas. You can find it on our website. And there's a networking tool that's being used there to help connect, right? But then also I have a sales pipeline that I can download that to later, right? And so and people all listening are like, attorney, sales pipeline, what's going on? What? I need to draw business, right? My job is to create business for the law firm. I think those things are kind of one of the most important tools that I can't live without, because it allows me to maintain networking feedback, right, from the event itself, and then also plug it into my sales pipeline. And that's probably the most influential tool. Personally, I'm very low tech, so like I would say the one thing that I one tool that's awesome for me is, like, my kid's school has this parent teacher app.
Yeah. And
it's awesome because I can, they take the photos of the kids. I can watch, they tell them what they ate, what their nap time was, photos of playtime. It's a nice distraction from in the day when making sure my girls are okay. That's a really cool one. Shout out to my kid's school for that. So.
Yeah, I love it. Hey, for that networking app, do you know or remember the name of it?
Yeah, so we use a company called Brella, and so we really like Brella. There are a couple of other networking apps that exist. Some conferences create their own. I like Brella because, like, Brella works really well because it links to your LinkedIn. You can set it up to link to your calendar, and you can set meetings through it. So it's great, and you don't actually even need the list at a conference. Everyone's on it, right? So it's quite useful. Shout out to Brella. They're fantastic. We've been working with them for, like, I think 3-4 years now, and we use them for all our conferences. And it has to be used by the conference sponsor, right? It can't be used by the individual. But if the conference has that tool, it's incredibly useful. So I know you guys throw summits. Like, it's a really useful tool to allow folks to set their own meetings through the app. And it's almost like a dating app, because you set your profile and it'll match people for you. That's awesome. Just so incredibly useful, because when I go to a conference, there's just, so many different areas that I can talk about, and I can't meet everybody. So it's been quite useful.
I love it. Give me the book you've recommended or gifted the most in the last year.
Gifted the most is probably Extreme Ownership, if not, I think it's like 7 Habits of Highly Effective People, something like that. Those two books are business books, ownership and discipline and accountability, those kind of things. Incredibly useful in business. can't say that I actually read them in the past year because I read them a long time ago, made an
Yep.
impact on me, and I've shared them. The only other book that like really, really made an impact on me was a sales book. Actually, it was one of Jack Daly's books. I don't remember the name exactly. I think it was his sales system book. That was it was just for someone who is selling business to business services, legal services is just that, right? If you think about it, it really changed my mindset about selling service and adding and switching to an value add proposition, and also got me really organized when it came to my pipeline. So I can't recommend that book enough. Anyone that is in sales, I mean, that's the first book you should read. So
What's a daily habit that helps you stay focused on your goals?
this is hard, right? Because anyone that works with me will tell you that Kevin has the worst ADD you'll ever see in your life. For me, it's literally just a Word document that I keep, priorities on, and then my wife and I keep the similar kind of agenda that we're constantly amended agenda that we're working on. And then also I have like a, kind of an online, I use like Zoho projects for something like that. Like when I'm working on a project for myself, even that and my team. So those kind of things are basic, very simple, but it works for me. So
Give me your number one insight for private lending.
Regionality and focus is probably going to be the long-term key to success. Every lender that I've seen that's not only scaled, but also has established dominance in their markets have not tried to become the next Kiavi. And if you're institutional, it's a whole different story, right? But the folks that I know that are building a business, they're entrepreneurs, they built a business that lasts, that's dominant and has scale. It's regionality, it's hyper focused in core competencies, right? They don't go outside of their credit box, and they don't go into new markets on a whim. They only lend in like 1, 2, or 3 markets, and they kill it in those markets, right? And so that's what I always tell folks who are trying to build a private lending business. And right now it's proof of it, right? In the tough times, the local regional lenders are just killing it. They're busier than ever. And if you're a national shop, if you're an institutional shop, you're in all 50 states, you may smile at that, but you have to respect the game, right? Because these folks have built a local business, and long term, they're attractive prospects for those types of folks. So I think that's the key to success if you're a private lender and you're an entrepreneur in this space.
You are out there in Irvine, California. Give me your
Yes,
favorite place to grab a bite to eat.
In Irvine, there's a bunch of great restaurants, but I would say the favorite place, if I get a chance to eat there, is, I think it's a chain actually. It's this Vietnamese restaurant called Little Sister at the Irvine Spectrum. My team members, Jen, turned me on to it. Great food, great ambiance, great drinks. And then there's also this it's not tiny actually, but decent sized it's like a Japanese home food restaurant. It's not sushi, it's like what Japanese folks eat at home. Fukata, it's on I want to say it's on Irvine Center Drive, but like 10 minutes from our office. Great food as well. So yeah,
Love it, man. We'll have to check those both out.
Listen, they're great.
Kevin, you gave us a lot of great information, right? Talking about private lending, kind of your background in legal space, but also just recognizing like, hey, listen, there's lots of opportunities. And if you want to get into this space, you just have to do a little bit of homework and know your background. But one thing that jumped out to me is you mentioned that 50% of the new funds that you're setting up, people have backgrounds in real estate, right? They're either flippers, they're multifamily investors. So if you know real estate, love real estate, make money in real estate, there could be an opportunity to make money on the paper side of the business, right? You just have to understand the legality and some of these different things. The term usury, you mentioned a couple times. We got to learn what that was. But I would just say that the big thing is learn about the space. If it's something that you want to embark more upon, reach out to a group like Kevin's. You can go to JurassiLLP.com to learn more. You have an event coming up here, so I know that's on the website. You've got a podcast yourself. So make sure you check out some of these resources if this is an area you want to explore a little bit further. Again, that's JurassiLLP.com. Kevin, I want to thank you again for coming on the show today, being a great guest, and we look forward to staying in touch.
Thank you very much for having me.